Welcome to ForexTV.com. Today's Monday, October 19th. I'm Tim Kelly with the New York Forex Market Buzz. Now from the Brewer Futures Research Desk, the U.S. dollar resumed its downward trend after trying to mount a small comeback late last week. Better than expected earnings or projections for better earnings in the future helped drive up equity prices, which in turn boosted demand for higher risk assets. Euro-U.S. dollar is getting close to the psychological 150 resistance barrier. This is taking place while Eurozone finance ministers are meeting in Luxembourg. This opens a door to possible commentary from the members regarding their concerns about the rapid rise in the euro and its possible negative effects on the Eurozone's economic recovery. The British pound US dollar has erased all of its earlier losses and is now trading higher. This morning the British pound opened under pressure after a story leaked over the weekend that the Bank of England was considering expanding its asset buyback program. Last week, speculators drove up the pound as comments from a BOE official hinted that it would end the program. Today's action demonstrates that positive momentum is still present in the market. The rise in equity prices is driving up demand for higher yielding assets. This is helping to put pressure on the dollar-yen as traders continue to pressure the U.S. dollar because of its low interest rates. Traders continue to treat the dollar as a carry currency because of the Fed's decision to keep U.S. rates at the lowest level in the world. Demand for higher risk assets such as crude oil and equities is helping to boost the Canadian dollar. This is occurring despite tomorrow's Bank of Canada meeting. Traders expect the BOC to leave interest rates unchanged at this meeting, but may discuss changing interest rates sooner than expected if the economy begins to heat up. Some investors feel the current rally could be curtailed if the BOC expresses concerns about the rapid rise in the Canadian dollar and its possible negative effect on Canadian economic expansion. While strong demand for higher yield is helping drive up the New Zealand dollar and Aussie dollar trades, traders are now speculating the Reserve Bank of New Zealand and the Reserve Bank of Australia will raise interest rates at their next meetings in November. Some investors even placing trades in anticipation of the RBA hiking as much as 50 basis points. Gold and crude oil futures are climbing today as well, and the yield on the U.S. government 10-year note is 3.39%. That's down 2 basis points. Today to discuss some of the Forex action, we have Greg Michalowski, VP of Trading and Liquidity at FXDD. Greg, welcome.
Hey, thanks, Tim. Thanks for having me.
Well, happy Monday to you, Greg. We're in the middle of the day here. It's gotten a little bit quiet on the FX side, but we did have some moves today, and I know you've got some thoughts on some currency pairs that are making some headway here. I wanted to start with you on the dollar Swiss trade. We didn't mention that in the intro, but I know you've got some charts and have been looking at some movement there.
Yeah, clearly, Tim, the dollar Swiss, well, it's trading near the 2009 lows here. In fact, we made a new low today just by 3 pips at the 101.14 level. Last week we reached a low of 101.17. The trend remains your friend in these currency pairs, and the dollar trend remains the same as well. But from a shorter-term perspective here today, we are seeing some resistance up ahead at the 101.35 level. And I went back in time, looked back at like 2008 levels, and the 101.35 level was a key level of resistance or support and resistance. But going back, I think, to July of 2008. And this afternoon, if you put up I sent you a 5-minute chart, and you can see how the market really has been waffling around in between the 101.35 as the high and the 101.17.14 level as the low. So the market is kind of at a point of a decision here. Does it want to go higher or lower? And also at that 101.35 level, if you look at this chart, is the 100-bar moving average on the 5-minute chart, and that's always a short-term trading moving average that I do like to watch. And so I think as the market non-trends here over the last couple hours in the dollar Swiss, it's kind of making it's coming to a decision point for that currency pair. And if we're able to move above the 101.35, I think we have a chance to see some correction in the dollar. Of course, we got to worry about the stock market, and that keeps on going higher. But from a technical perspective, it would look good for the dollar. And but if we break below that 101.14 level, my next level off the daily chart is a trend line in a channel that I have there that comes in about the par level for that currency pair. So that would be my next target on the downside for the dollar Swiss.
Greg, I'm just looking at the daily, and the drop started about 2 weeks ago. The recent move down. In terms of that movement, what do you think the drivers are to continue this channel down?
Well, last week Roth, S&B's Roth was on the wire, and he did mention that he thought that the Swiss economy was expanding at a greater pace, let's say, than the Eurozone economy, or perhaps even the U.S. And this had an effect of raising the demand for the Swiss franc. Also, when the market gets the Swiss franc still is a currency of a safe haven type thing, and although things like gold are still going up, maybe it's a hedge against some more uncertainty that may come out of the market down the road. But whatever the case is, the dollar Swiss continues its trend to the downside, and part of it may be as a result of a better chance of an expansion or a relative from that nation, and part of it may just be the dollar weakness that we continue to see, and as long as stocks go up, the dollar gets sold, and that's one of the currency pairs that seems to be caught in that cycle that we've been seeing over the last, goes back a long way actually.
Okay. Hey Greg, well, let's keep this moving here. I want to get in a couple more pairs here. So let's take a look at this sterling trade. There's been, I read a couple of things in the opening about, it's not necessarily a verbal intervention here, but a lot of press leaks and things like that. When I start seeing that, I start to scratch my head and say somebody there wants to move sterling. So why don't you talk a little bit about sterling, what you see there in the charts?
Well, as you mentioned in your comments, the on again, off again. Are they going to do more quantitative easing? Are they going to do less quantitative, or not do more quantitative easing? Seems to be the question, and it kind of goes back and forth. And when they threaten that, or they think that they're going to do more, that the pound sterling gets hit, like we saw in the opening. And when that feeling goes away, I guess it comes back higher. And today, though, we did go through a key technical level, and this was tested on Friday as well, and that's on the daily chart. We have the 100-day moving average, which comes in at the 163.49 level. And that level was broken on Friday, but we closed at 163.53, so kind of right on the moving average. Close enough to make it roll over till Monday, let Monday decide which way we're going to go. And with the market currently trading 163.97, it seems to be to the upside. And so from a technical basis, being above the 100-day moving average is certainly a positive for that currency pair. And the reason is, as well, in addition to just being above a technical level, is it tends to attract the longer-term type traders who look at that moving average. So direction in a currency is often dictated by the swings in supply and demand. And when you go above a thing like the 100-hour moving average or 100-day moving average, you should see further momentum to the upside. So where's my next level on the top side? 164.51 is a trend line. If you connect highs from July high and the September high comes in at that 164.51, that would be the next top side for me on the sterling versus the dollar.
Right. That I'm just looking at the charts here, Greg. That kind of coincides with the breakdown, the kind of the second leg, or early in the breakdown back in September, about the mid-September level when we broke down. So retracing a little bit from there.
Absolutely, that's true, Tim. It does come down from that level, so it would be a logical level for the market to pause.
Okay. Hey, Greg, let's jump over to euro dollar. Just want to take it from the top here. Tell us what you see there.
All right. From a technical perspective, I have a nice channel coming in, going back really to the end of May there. If you connect the highs we come up to a trend line that comes in at the 149.60. Today's high came in at 149.62. Currently trading at 149.49, so not far from that high trend line. Of course, over the last few weeks, the euro has been trending to the upside, and over the last 4 or so days, it's been consolidating. That's not unusual. It allows for things like the 100-hour moving average to catch up to the price, and then the market has a decision to make whether it wants to break that upper trend line and head it, like you said, up to that 150 level, or are we going to use this resistance level as a level to take some profit and move lower. So really, that 149.62 level, break above, I think we're going to see further momentum to the upside. If we're able to hold it, I think we're seeing some sellers against that level right now. We have a chance to move lower, and if we do move lower, the 149.04 type area is my next level of support. That's where I have the 100-hour moving average currently located at.
Okay. Hey, Greg, on the daily, I'm just looking at the daily. We had that big run-up at the end of last week. Then we started moving sideways starting Thursday and Friday, and today we're moving back up. Is that would you consider that a bullish pennant formation? I'm just going to talk technical analysis here with you. So just want to know if that's what our viewers should consider a bullish pennant formation.
Yeah, up there at the top. I mean, it certainly is. The problem is at that top on Thursday and Friday we did have a double top at the 149.67.
Right.
That kind of puts a little bit of a bearish slant in the argument. The market doesn't tend to like double tops, but I am impressed by the move back higher today. So if we do see a breakout to the upside, don't fade it. I think we're going to see further buying.
Yeah, it seems that every time you try to fade this dollar weakness, certainly in the last 2 weeks, and especially with the high yielders and the commodity currencies such as CAD and Aussie and New Zealand, those dips just get bought right up. This goes back to one of my mantras, and that is to trade the technicals that are out there. And from a longer-term perspective, obviously the technicals are pretty clear, especially in those commodity currencies. But you can also go down to the shorter-term technicals. Let's say a 5-minute chart, looking at 100-bar moving average on a 5-minute chart in some of those currency pairs, and you end up getting short-term sell type corrective type moves, but they're very shallow, and the market quickly reverses those moves and heads back to the upside. And those are reflected in the price moving back above these moving averages. So I always like to look at the technicals to have it tell me that don't try to pick a top, get back in the trade, and especially against some of these commodity currencies. Okay. Yeah. Well, the other side of that, Greg, is can't last forever. A lot of folks get comfortable buying those dips, and I guess the advice here is just manage your stops.
Well, that's where the technicals tell you to go short again, Tim. If it goes below a moving average, look to sell on the break and have the market stop you out if it goes back above those moving averages. It's the power of the moving averages that kind of get you in and out.
Right.
But don't ignore them. And don't fall in love with the position. Let the market tell you what to do.
Probably the best advice any trader could take, right?
Yeah, it's all about controlling risk, Tim. It's all about keeping that risk to a minimum and using what the market price tells you how to trade the market. That's as easy as that.
Okay. Hey, Greg, thanks a lot. I appreciate it. Thanks for staying with us. We're a little late today. I appreciate that.
Thanks for having me. I look forward to the next time.
This has been your New York Forex Market Buzz with Greg Michalowski from our good friends over at FXDD. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.